In this lesson, we're going to talk about present value. Present value, or determining present value through the process of discounting, is the opposite of determining future value through compounding. And we use present value quite a bit, especially like in the valuation of commercial real estate. But present value tells us the amount that we would be willing today to pay for an investment based on an assumed rate of growth when we know what the value of the future cash flow or cash flows is going to be. Let me give you an example of present value in a very basic form. Imagine you have a friend that has a bond that's going to cash out for $100,000 1 year from today. But your friend says, hey, I need money today, and I'd be willing to sign over that bond 1 year from now if you would loan me money today. So let's imagine that you are requiring a rate of return of 100% on your money. You want to double your money for any investment that you make to this person. Well, that would mean that you would loan them $50,000. In other words, you know you're going to get $100,000 a year from now, and if your required rate of return or your discount rate was 100% on your money, then you'd be willing to loan $50,000. You would make $50,000 in interest for a total of $100,000. Let's say that you didn't require a 100% return or double your money, but you wanted to make 50% on your money. If you wanted to make 50% on your money, that means you'd be willing to loan your friend $66,666. You would loan them the $66,666. They would repay you that plus $33,333, which is 50%, for a total of $100,000. In other words, $100,000 discounted back 1 year at 50% is $66,666. Now let's say you only wanted to make 25% on your money. If you wanted to make 25% return on your money, you would be willing to loan your friend $80,000. You would loan them $80,000. They would pay you $20,000 in interest, which is 25% of the $80, for a total of $100,000. In other words, $100,000 discounted back 1 year at 25% is $80,000. The present value is $80,000. So in order to determine the present value of an investment, we need a specific amount of time, and we need a future value or a future series of cash flows, and then we need a required rate of return. And that's the essence of present value. Let's take a look at another example. In this example, we want to know if we have an investment opportunity that's going to pay us a one-time cash payment 4 years from now of $20,000, and we require a 6% return on our investment annually, how much would we be willing to pay for that investment today? In other words, $20,000 discounted back 4 years at 6% is $15,842. In other words, an investment of $15,842 today that compounded at 6% for 4 years would be worth $20,000. Now I'm going to show you how these are input into the financial calculator so we can start working through some of these problems together. The way this would look in the calculator is we have, in this example, a 4-year investment, and in this case it's compounded annually, so we just have 4 compounding periods. So our N, or number of periods, would be 4. Our required rate of return is 6% per year. So per compounding period, we require a 6% return. We're solving for present value. There's no mention of any periodic cash flow payments. It's just a one-time payment at the end, which is $20,000. This is how would we put it in the calculator. When we solve for present value, we would get an answer of negative $15,842 $20,842. The reason that is negative is because in the financial calculator, the cash flows follow the cash in and out of the pocket. In other words, an investment today of $15,842 would be cash out of the investor's pocket into the investment. And then at the end of the 4 years, it would be $20,000 cash into the pocket, so that would be positive. In this present value example, let's imagine that we are investing in a project that is a 10-year investment, and we require a 12% return on our investment. But this particular investment, instead of paying us a lump sum at the end, is going to pay us $2,150 every year for the next 10 years. And as we've discussed before, present value is determining how much a future cash flow or future series of cash flows is worth in today's dollars based on an assumed discount rate or rate of return and an assumed period of time. So let's see how we would put this into our financial calculator. In this case, once again, we have a 10-year investment compounded annually. So it's 10 compounding periods. And for each of those compounding periods, we want to earn 12% return on investment. In each one of those periods, we would be receiving a positive cash flow of $2,150. There's no additional final cash flow, so that would be zero. And what we want to know is, what is the present value of that investment today? So entering this into our calculator, we would get an answer of $12,148. And once again, remember that that answer would come out negative because this is an investment, cash out of pocket into the investment, that yields a positive cash flow back to us of $2,150 every year. In this last present value example, let's imagine an investor wants to buy a piece of land. They're going to hold that piece of land for 5 years, and at the end of the 5 years, they think that land will be worth $50,000. The investor wants to make 10% return annually on their money, and also, the investor is going to have to incur property taxes, a negative cash flow of $1,500 per year for each of the 5 years before selling the property for $50,000. And assuming that discount rate of 10%, wants to know how much to pay for the land today. So the investor wants to invest for 5 years, making a 10% annual return compounded annually. They're going to incur negative cash flow of $1,500 and a positive cash flow at the end of $50,000. Solving for present value would give us a $25,360 present value.